Oftentimes, the hardest part about investing is the part where you wait and do nothing. And right now, the market is buying time, waiting for PCE data, as today's GDP data was a nothing burger. So what exactly should we expect from PCE? Today, we're going to be talking about PCE expectations and what happens before and after the release of the Fed's preferred gauge of inflation and the likely outcomes for every scenario. We're also going to be diving into the rate cut situation and what sectors will benefit the most from rate cuts. And lastly, we're going to be talking about smart money positioning and sentiment. What are smart money buying and what exactly are they selling? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. A lot of green, a lot of red, and the red led by credit services here in financials, as well as Nvidia. You know, Nvidia really seeing a lot of bearish action at the top, quite a lot of volatility. And we did see the same price action here in Microsoft and Apple, but most of tech was actually pretty good. I mean, okay, excluding semiconductors, software was actually really positive today, particularly led by CRM, ServiceNow, and Intuit. And then infrastructure tech diverged from what Microsoft did, and they were green. We also saw green here in Google, Meta, Amazon up another 2% after up 4% yesterday. Tesla put in a 0.45% gain. Rate sensitive stocks really did perform today. Real estate, utilities, basic materials did as well. It was a very green day across the board, but really weighed down by the bigger names. And I think it's because GDP data, we got GDP data today, it came in line. And because the data came in line, the market is just staying tentative ahead of tomorrow's PCE data. Now, looking at overall sectors, we saw that rate sensitive sectors, regional banks, real estate were the best performing sectors, followed here by software. They were up 1.39%. Then we actually saw stuff like XLU, XLY, XLF, XLC. They all outperformed the S&P 500, with the worst performing sectors being semis, materials and mining, staples, GDX. And pretty much it was defensive sectors and commodity driven sectors were the worst performing sectors here today, along with semiconductors. But cyclical sectors actually did really well. Rate sensitive sectors did really well. But the market is waiting ahead for the PCE data. I think if the PCE data comes in line tomorrow, that's going to embolden rate cuts for September. That's going to be good for stock. I think the market right now is pricing a September cut. I think it's pretty much all but a short unless we actually get hotter than expected PCE tomorrow. But if PCE comes in line or cool, I think September is definitely on the table. And the market is definitely trying to get a lead in some way or another. I mean, the 10-year yield was actually down 1%, but we're actually still up on the week here, but down for the day, down 1%. Now, on the back of yields falling and bonds rising, the AGG was up 0.16%, TLT was up 0.4%. We actually saw small caps. The IWM was the outperformer here today. Small caps actually returned 1% on the day and actually looking a little bit upbeat here in the after hours, up 0.09%. I know it's pretty much flat. We saw the bigger indices. The S&P 500 was virtually flat here for today, and the Nasdaq 100 eked out a very small gain of 0.19%. What's also very interesting about the market as a whole is if we go to the RSP, the equal weight, we actually saw the RSP was up 0.12%. So again, really flat, slightly upbeat in the after hours as well. But we saw breadth improve. We saw breadth dynamics improve. More stocks gained here than declined, and we saw a breadth dynamics continue to improve. And I said this yesterday, right? Even though the advanced decline line doesn't look that great on the S&P 500 cap weighted indice, on the equal weight, it's actually trading as it should be. I mean, you know, we haven't quite hit all-time highs in the RSP and we haven't hit all-time highs here in the advanced decline line. If this goes and makes an all-time high, let's say tomorrow, maybe Monday, while this trades sideways, that's actually a positive divergence, and that would be positive for stocks. But you also want to have a look at the advanced decline line in the context of the S&P 500. But with regards to commodities here today, gold was up 1.27%. Very interesting day of trade. But silver didn't follow suit. Silver was only up 0.83% here today, and crude up another $1.27, forming a little bit of a top here. I mean, if it does go break, we could actually see a little bit of a rally to some of these highs here close to the $84, $85 region. Very bullish price action from crude. To see this leading into the presidential debate is very interesting. A couple of our risk on, and then in light of everything that happened today, the dollar actually fell 0.12%. But let's talk about the S&P 500. Now, 5,300 is the put support in the S&P 500. This green line right here, that's the call gamma resistance, and this is the gamma flip. And you can actually see some very interesting developments. We are literally trading in a very tight range in between the gamma flip and the call resistance. That's exactly what we're doing right now, waiting to exit the window of weakness and waiting for this PCE data. And I do think tomorrow's PCE data, whether in line or hot or cool, is gonna see us make a big move either above the 5,500 or below the 54.45 area. Now, if we do break below, we can look to support at 5,300. To also take into consideration that in the grand scheme of things, we are overbought on the RSI. Not necessarily a bad thing or a bearish sign, but just something to note nonetheless. Something else to also note is that if we do break above this here, let's say tomorrow, we would then need to look for a move up in the call gamma resistance to the 5,600 area. Otherwise, any break above the 5,500 area will be short-lived, but we can definitely see an intraday bounce above and actually close the weekend above. That would be constructively bullish. But for the S&P 500 right now, you don't really want to do anything, not without any confirmation of the call gamma resistance. As long as it stays at 5,500, you just want to sit on your hands, wait, hold the positions you're in. I know that a ton of you, including myself, are long from here, as well as like longer dated positions here at the October lows is where we're long from. But sometimes the hardest thing to do is just let price action play out. And that's what we're willing to do. Let price action play out. Let the options market tell us what's going to happen next, and then we react. So long story short, sit through the volatility. Now, looking at the AA sentiment survey. So essentially what the survey does is it looks at bullish, neutral, and bearish sentiment votes. And they ask the question, what direction do AA members feel the stock market will be in the next 6 months? And very interesting dynamics we're seeing. We saw bullish sentiment actually tick up ever so slightly here from last week, and bearish sentiment also tick up in a very, very big way. And essentially what we saw is those people in the neutral camp just take a position here in the bearish side. And I think that has to do with the couple of the dynamics we're seeing with breadth, geopolitics, valuations, and just the way the market is trading right now. We're moving from the bottom left to the top right in the S&P 500 with very, very minimal pullbacks relative to history. That's why people are getting a bit nervous, but you have to look at this. Sentiment is still very bullish. Investor sentiment in the long term is unchanged. We're just seeing people here in the neutral zone just move towards the bearish camp, which indicates a slightly more negative outlook. And a big reason for this change in sentiment could be the election. We actually see that volatility tends to start rising around 1 month before the election day, and we do see quite a bit of volatility, even though it does trade sideways. And then sort of around, you know, the 38-day mark, the 50-day mark, and this is trading days, so you're looking at close to 2 months in calendar days, we see volatility rise into the election. And then after election day, once we find out who the president is, we do see volatility taper off. So with the presidential debate up and coming, with election campaigns in full gear, we could be experiencing some of the entrenched volatility that we normally get before the massive run up into election day. All right, let's dive into earnings. So we had a couple of big names report this today. Nike. Yeah, after the hours, we're going to dive into them, as well as Walgreens. Walgreens were actually down at 1.22%. I still think they are on just their earnings being an actual dumpster fire. They're closing stores. Management came out and blamed the weak operating environment, blamed the consumer, took no responsibility, and the stock was down 22%. A really, really rough earnings right there. And we also had another rough day of earnings here for Nike. Stock was down 5% in the after hours. That's because earnings were very, very mixed. We beat on EPS, missed here on sales. EPS report was 99 cents. Market was expecting 85, so that's good, I guess. But sales of 12.6 against 12.8. So long story short, this EPS figure could have actually been better if the revenue was better. We also saw direct sales increase 6% year over year to 5.4 billion. Inventory actually went down. I think that's a positive about this earnings, is that Nike's getting rid of their backlog inventory. And then share repurchases of $1.1 billion. But the market didn't like the earnings, down 5.14%. And yeah, you know, the consumer continues to favor other brands, and changes of preference continue to be a hindrance here for Nike. So I still wouldn't buy the stock. I still believe Nike is quite overvalued in my personal opinion. If we pull up a simple discounted cash flow analysis, use these earnings, free cash flow right here, this terminal rate and discount rate, a growth rate of 1%, you get a fair value of $79. You know, the stock right now trades at $94 and now $89 here in the after hours. You know, you're still heavily overvalued here based on the current free cash flows here at Nike. So definitely not something I'm looking at. I think it needs to go lower for it to become attractive. Now, Nike normally caps off the earnings season. We do have about one more week of earnings, but there's not many companies at all. And then from here, the 7th of July, Q2 earnings season kicks off. And really, we have a couple of companies here in the first week and second week, mostly financial companies. And then it ramps up here towards the end of July into August, where we have the majority of S&P 500 companies, especially the big names, the big tech companies, reporting as well. So Q1 earnings is pretty much done, guys. So onward and upward towards Q2 earnings. Now, the expectation here for the second quarter earnings for the S&P 500 is actually 9.2% in the earnings side, 4.7% here on the revenue side, with the best sectors being the obvious winners: comm services, discretionary, and technology, producing the highest earnings on the revenue and earnings side for the S&P 500. Now, let's actually talk about the stock market and where money is moving, what people are buying, and what do fund flows look like. Now, passive equity flows are on track for a record year. You can see this is active passive and then the projected annualized figure, and passive fund flows are expected to be at record highs, on track for a record year, and investors are putting their money to work. And that is if these figures do materialize. Now, at the same time, long only funds are 7% overweight the largest 10 S&P 500 stocks, as you can see right here, and 4% underweight the rest of the S&P 500. Clearly see right here that value or low PE is 50% underweight versus 3-month momentum. And generally speaking, in the S&P 500, you're not really going to find low PE stocks. Maybe you will in stuff like energy and materials, but they're a very, very low weight in regards to, you know, the top 10 stocks: Microsoft, Apple, Nvidia. So value heavily underowned at the moment. Momentum is 20% overweight, the most overweight in long only funds, followed by GARP, growth at a reasonable price, growth, and then quality. We could see here that risk and value is heavily underowned, as well as corporate cash deployment, essentially just bonds or corporate credit. And momentum is actually at near record highs. Oftentimes when we do get here, we do see a massive pullback. If we do get a rotation from momentum into these other growth factors, maybe stuff like value or quality, don't be surprised, especially if we do get election year volatility. And what about hedge funds? Hedge funds exposure to cyclical versus defensive sectors is at an all-time low. Cyclicals being discretionary, energy, tech, industrials, and materials, and defensives being healthcare, utility, and consumer staples. And you can definitely see a trend. The market right now is all in cyclicals. People are buying tech, people are buying consumer discretionary, people are buying financials, people are buying stocks that benefit from a strong economy. Now let's actually talk about the economy and GDP. Tomorrow we get PCE, a very important inflation print for the Fed. It's really going to determine what they do for rates in July or September, so pretty important. But this right here is S&P 500 performance before and after PCE releases since September 2022. So really what's happened before and after the PCE release in this bull market. And we can actually see here that one-day performance normally is actually very positive, 0.31% average return, but the hit rate's not that great. 5 days, 0.23%, average percent of the time up 72.2%. And generally speaking, after these prints, we've seen actually fairly positive returns, even though on the day we can get quite a bit of volatility. The market in bull markets tend to brush these off. They look ahead to the future, and stocks tend to keep rallying. You can actually see here that 5 days later after the PCE print, we see returns of 0.26% and 1.31%. And most recently here after the April print, we saw 4.6% returns 1 month later. Now we'll see if this is to materialize in the way of the data, but history tells us if we do get volatility in PCE, we should buy that dip and look for higher prices. Now, what are our expectations? Well, according to BOFA, we are expecting headline month over month, year over year, coming at 0.1 and 2.6%, and then core month over month, year over year, the expectation is 0.2 and 2.6%. We also have the personal savings rate, that's at 3.8%. Personal spending 0.4%, Chicago purchasing managers at 32, and then University of Michigan sentiment at 65. Those are the key data points to keep track of tomorrow. GDP came in line with expectations at 1.4% growth here. This was the quarter over quarter seasonally adjusted figure. Now, BOFA's expectation was 1.5%, and it did miss in that books, but pretty much every other source said 1.4% was the expectation, and the markets did actually positively react at the release of GDP. So I guess 1.4% 1.4% probably was the inline figure. So the market definitely did like the GDP figure overall. Along with the inline GDP here at 1.4%, we actually got like weaker durable goods orders, both in transportation and defense. But durable goods orders here for May did come in a little bit better than expected, 0.1% versus the negative 0.1% consensus. And then we actually got weaker jobless claims as well. So pretty much what we got was stronger growth and then weaker slash inline mixed data with all the other prints, and the market really did like that initially. In the pre-market, in the live stream, the market went pretty much from flat to up 0.2, 0.3% in just a couple of minutes, but it didn't change rate cut expectations that much. It is still looking like we probably are getting the first rate cut here in September or November, the first 25 basis point cut, and it does look like for the full year 2024 we have 50 basis points worth of cuts priced in. Now at the market pricing in as much as 50 basis points worth of rate cuts, where do you want to be positioned in a time like that? Now this right here is just some data from BOFA, and it says after the first Fed cut, value-led growth for 6 months, small-led large, 3 months, 6 months, and 12 months, and bonds-led stocks. This factor performance prior and after the first rate cut. This graph isn't too great. I don't like it. I actually have the sector performance right here of the S&P 500 around the first rate cut. So you got 1 month, 3 months, 6 months, 12 months, and the best performing sector. Now, this is very, very interesting stuff. You can actually see that after you get your first rate cut right here, let's say this is September, the best place you want to be for the first month, 3 months, and 6 months is actually consumer discretionary along with energy. That's really where you want to be positioned, right? And then after the 6-month period, the best place where you want to be positioned is tech, materials, and real estate. They're the outperformers thereafter. So it's very, very weird. Again, this is outperformance against the S&P 500. So, this means it's leading the S&P 500. And this doesn't mean that like these sectors aren't necessarily bad, or that industrials, since it underperformed the S&P 500, the majority of the time is a terrible sector to be in. It's just saying that these outperform the S&P 500. So where you really want to be in is stuff like real estate, materials, and technology 6 months after the rate cut, and then consumer discretionary, energy 1 to 3 months before. You can also see right here financials about half the time actually beat the S&P 500 6 months after. That's definitely a sector you want to look at if you do want to diversify into financials. But here is the data. You definitely want to be in technology, and you definitely want to be in rate sensitive sectors leading into that rate cut. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.